Hey, Kevin, this is Arn Cenedella, Spark Investment Group. Appreciate the opportunity to chat with you today, and hopefully we can provide some value to your listeners and help them on their real estate journey, invest in real estate, create income, create financial security, and so forth. Um, I got into the real estate business back in 1978. Uh, Born and raised in the San Francisco Bay Area, grew up Los Altos Mountain View. Like most middle income American kids, went to college, got a degree. My master's degree is actually in chemistry, though I never did.
Wow.
Yeah, I never did anything with it. Um, my father had started a residential brokerage business in Menlo Park, California, which is next to Palo Alto. And I called him up one day and said, "Hey, Dad, I don't think the academic life is for me." At one point, I thought I wanted to be a professor or perhaps a researcher. And really, I'm kind of more social than that. I didn't see my life in some basement lab tweaking these instruments for 20, 30 years. So he said, "Well, okay, Arn, come on out, get your real estate license and I'll put you to work." And it was about a 5-minute conversation. And so returned to the Bay Area where basically I'd spent most of my life. Went to work for him as a residential agent, soon got my broker's license, and was
Man.
basically a single family residential broker for about 35 years.
Oh, really? Very
Yes.
cool. What was your brokerage's name?
It's Cenedella and Company. So it was my father's company, relatively small. We had 2 locations, one in Menlo Park, California, and one in a town over the hill towards the coast in a little town that some folks may know is La Honda, which back then in the 70s was kind of a hippie commune. Ken Kesey, if anybody remembers that name, he was kind of out there. And so I actually started in the La Honda office and then kind of got tired of driving over the hill. It was about a 30-minute drive, and moved into Menlo Park. And that's where I spent most of my residential brokerage career.
Well, very cool. Thank you for that introduction. And you have so much value to provide. I don't even know where to start. I guess we'll just take it one question at a time. How have you seen the real estate market evolve over the past 4 decades, particularly in high demand areas like Palo Alto and Menlo Park?
Well, yeah. So everybody kind of knows prices are astronomically high in the San Francisco Peninsula, Silicon Valley. When I started in 1978, kind of a rule of thumb was 100,000 per bedroom. So 2-bedroom would be worth 200,000, 3-bedroom would be worth 300,000. And by the time I left Menlo Park to move to Greenville, South Carolina, 2014, it was kind of closer to $1 million a bedroom. So a 3-bedroom home in Menlo or Palo Alto might be $3 million. So, I had the good fortune to kind of be in the right place at the right time. And, I still kind of keep touch on the California real estate market. And as I mentioned to you, I was actually born in Marysville, California, above Sacramento.
Very
So
cool.
I know the Central Valley. And sometimes I look at prices like in Stockton or Livermore and so forth, and they've jumped up quite a bit. So, what
They have.
what I tell people about the San Francisco Bay Area and its market, and by extension, all of kind of California, is the buyer pool is basically the world. And by what I mean by that is any person who kind of wants to find their fame and fortune, whether it be tech, media, whatever it happens to be, where are they going to go? They're going to go San Francisco Bay Area, maybe they go New York, maybe they go LA. And when you think about what's the combined population of, I don't know, let's just take a stab at China and India, which I think is probably 10, 12 billion. A lot of those folks want to have their kids come here, be educated here. They want to invest here. Their capital is safe. There's private property rights where in other areas of the world, maybe the private property rights aren't quite as strong. So it's kind of a world market, and therefore the prices reflect the market for San Francisco Bay Area property isn't 50 miles in diameter. It's the entire globe, right? And
That's a good point.
1% of 7 billion people is still a lot of people. So if you think of the richest 1% in India or China, that's still a huge number. And that kind of drives the real estate market. And there's opportunity. When I sold real estate in the Bay Area, I had a lot of friends who came from Russia. They tended to be software engineers and software architects, and they came here for the opportunity. They came here for the freedom. So great market. My father, in addition to teaching me the brokerage, was also an investor, and he kind of did it old school way, buying single family homes, and I kind of followed in his footsteps. So I started to build a single family rental portfolio in the Bay Area. But again, this was 1980, 1990. Prices were high, but still not where they are now. And then I moved to Austin, Texas, and hit that at a good time. So started investing with the income I made from the brokerage.
Cool. With the income. That's so you, man, that's a lot you did. I mean, like, just from 1978 like to now, that's so much experience and knowledge. So like in 2020 you transitioned from single family rentals to the multifamily investments. What motivated this shift, and what were some of the challenges and rewards you experienced during this transition?
Yeah, great question. So one, I'd done the single family rental game, probably accumulated at one point maybe about 30 homes. And it's a tried and true way to create wealth. So for newer investors, I would encourage you to try to buy a rental house. The way it started with me, I bought my first house in 1980, and it was in kind of a rough neighborhood, right up against Bayshore Freeway, Highway 101. So, you know, not ritzy, not fancy. Lived there 6 years, started making a little more money, and then moved to San Carlos and kept my first house as a rental. So that's how kind of the rental thing started. Bought my first house, wanted to keep it, could afford a little more expensive house, moved up. So I started accumulating rental houses. And then after about 40 years of doing that, one, I was kind of a little bored with it. Been there, done that, and I wanted to do something new. And the other thing is, we all know housing affordability is a real issue in this country. And
absolutely,
there's no easy solution. And so when you look at affordable housing, what is probably the two asset classes that offer the most affordable housing? I would say it would be apartments, multifamily, or mobile homes. And so I think there's a huge demand for affordable housing. So therefore, if you invest in apartments or mobile homes, you're almost going to have an unlimited number of tenants and residents who want to live. So I think There's a strong demand. It's an issue. And as an apartment investor, there's some satisfaction in delivering safe, habitable housing to people who work hard, but they're not making $200,000 a year. They can afford $1,100-1,200 a month rent. They deserve a great place to live. And so you can structure it good for your investors, good for the residents. The other part about multifamily is generally what I found is a single family investor, generally you kind of do it all. You wear all the hats. You find the property, you buy it, you manage it, you operate it, maybe you fix it up. And with multifamily, it's typically groups of 3 or 4 people that get together and as a team operate the asset. And so what that allows somebody to do is you can combine the skill set of the 3 or 4 people to kind of create a dynamic whole. So for example, I love hunting deals. I love talking to investors. I love raising capital. I don't like dealing with the minutia of collecting the rent and hounding the contractors and so forth. So when you go to multifamily investing, you can kind of create a team, and each member of the team can do what they do best, what they enjoy best. And there was an old book, like sometimes people think about, well, you should work on your weaknesses, but really, yes. So figure out what your strengths are and figure out how to maximize them. There's another book out recently, Who Not How. And so the thought is, if you're not good at something, the answer isn't maybe to learn how to do it. The answer is to find somebody who already knows how to do it, right? Who, not how. And so the multifamily is kind of more a team aspect. And I really enjoy the social aspects of the business. So love the multifamily. The other thing that's nice is just think about it. If you own a 40-unit building, you've got 40 income-producing units all in one place. And they may also be 40 identical units. Same floor plan, same square footage. So when you remodel them and you put in new countertop or you put in new flooring, you don't have to reinvent the wheel every time you do it because you already know this is a unit. I need X number of luxury vinyl plank. And they're all right there as opposed to having 40 units, single family houses spread out through your county or your city. So it's a lot easier to manage units that are together.
That makes so much sense.
Yes.
And you have like so much like, and you evolve towards like you start on the first one. Next thing you know, it's like by the time you get to like the next one, you're just like improving your process and everything that you're doing. Plus you're saving time. Like it just makes so much sense. And you're all in the same place. Like, yeah, that's awesome. And you're playing to your teammates' strengths. Like that sounds amazing.
Yeah. And it's true. Like when we buy a new property, the first unit we redo maybe takes us 7 days. And you kind of got to supervise your crew and you got to kind of figure things out. But once you figure that out, you've gone through the learning curve and now you can really accelerate it. And one of the big expenses for property owners is vacancy and turnover cost, right? So every day you have a unit that's vacant, it's costing you money. So to the degree you can speed that process. It may only be $25 here, may only be $25 here, but you multiply that over 10, 20 units, it does it. And then the crews just do it. What we do is my partner, Brian, who kind of handles the asset management and the renovation, we own maybe 5 or 6 properties in Greenville, South Carolina. And so we buy our stuff through Home Depot. No big deal. You can buy at Lowe's. It doesn't really matter. But on file at Home Depot, we own a property called the Cottages at Staunton Bridge. So in their computer, they have the material order for the cottages at Staunton Bridge. They know exactly what we need. So Brian calls them up 4 p.m. on a Monday. Hey, we need 2 renovation packages for cottages at Staunton Bridge. He doesn't have to go through each little item. I need 20 foot of counter space, whatever it is. And the next day, those packages are ready to be picked up. Crew goes, picks them up. They're on to the job. And of course, people can waste a lot of time running back and forth for parts. So when you systematize that, it saves money and time. So you're exactly right, Kevin.
That's very cool. You guys just have it down to like a science now, it sounds like.
We do our best, yeah.
Very cool. So can you tell us more about the founding of Spark Investment Group and its mission to help busy professionals and parents invest in commercial real estate without the operational hassles?
Yes. So basically, what I am now is a multifamily syndicator. I own some properties by myself as an individual, like many of your clients probably do. And they're great. I love them. They go up in value. They produce a little bit of cash flow. But mainly what I do now is a multifamily syndicator. And what we do is we reach out to investors, and most of our investors, our average investments, maybe $50,000. So you don't have to be a country club guy. You don't have to be worth $8 million to invest with us. It's just regular folks. And what I find is most people understand the benefits of real estate. It's kind of no secret. People bought a house 5 years ago, and a house down the street just sold for 50% more than they paid, and it's the same house. So people understand the benefits of real estate, but either they don't have the time to properly manage them, and it can be a hassle. It's no fun getting a call when you're headed out for vacation. My hot water heater just blew, and now you got to call a plumber. So maybe they don't have the time to devote to it. It also takes time to find properties. You know, you run out, you try to find it, you make an offer, maybe it doesn't go. So that's time consuming. So one, it's a time commitment to be a property owner, a landlord. And two, maybe some folks don't have the knowledge and education to do it properly. So you could have a doctor, you could have an attorney. They're obviously brilliant people, right? Very smart, but their expertise is in real estate. So what we provide is, I've been in the real estate business 45 years, my partner, Brian, about 15. We know how to do it. So what we offer to people is the chance to invest in real estate, which most people want to do, but they don't have to hassle with a leaky toilet or termites or collecting the rent. And we handle all the details. And in exchange, they kind of we distribute quarterly. So every quarterly, they get a share of the cash flow, and then they get the majority of the profit when we sell it. The syndication team, the general partner, gets a share of the profit at the end. And it's kind of great because if we don't produce a profit, our share of zero is zero, right? So basically it's kind of performance-based
That's cool.
compensation. The investors usually get all the cash flow, and then down the
Hmm.
road, if we sell at a profit, we get a share of the profit. The limited partners, who are the investors, get the majority share. And so, over the 3-4 years I've done it, I think we have 150 active investors.
Wow.
They've invested over $11 million with us, and they're happy. The deals are going well. Greenville, South Carolina is a good market. It's kind of between Charlotte and Atlanta, which everybody kind of knows is booming metropolises, and basically we're an hour and a half, 2 hours from each. So that's kind of
Perfect.
what we do with the multifamily and Spark Investment Group.
Very cool. Do you guys have like an average return on investment?
Yeah, that's a good question. And since we're relatively new, we haven't
Got it.
taken any deals full cycle. Um,
Okay.
we're kind of conservative investors, so we always get fixed rate debt, and people have heard of difficulties and horror stories with people getting floating bridge debt,
Mm,
which is equivalent to adjustable rate debt on a single family home. For multifamily, they call it floating rate bridge debt. So there have been
got it.
some people who have gotten into trouble. We do fixed rate debt. And I would say on the assets we own, we have interest rates between high threes and low fours. And
Really
yes, because most of the stuff that we bought was in 2021, 2022, before rates
nice.
went up. We'd like to do deals, but frankly, the last year or two, we haven't bought much because the numbers just don't make sense. And
Right.
uh, when you're asking other people to invest their capital with you, there's really a high level of responsibility. And so we're not going to do a deal just to do a deal. So we've got this great fixed rate debt. On most of them, we've got another 3, 4, 5 years to go. The properties are
Cool.
cash flowing. So we're just going to ride it out. We have an investor portal where basically quarterly we send out distributions via ACH. So they just kind of pop up magically in our investors' bank accounts.
Awesome.
And so that's kind of what we do. We're always looking. I actually went down, just came back from looking at a 50-unit new townhouse development that maybe we can buy as kind of a build to rent community. So
Cool.
talking to the builder, and he'll give me some numbers, and then I'll have my analyst take a look and see if it makes sense. So I'm always looking, but
I
you
love
got
it.
to be selective, in what you do.
No doubt. I mean, you're absolutely right. And not just where you are, but over here. I mean, like throughout the United States with these high interest rates, it just doesn't make sense for investors or a lot of buyers. Like, that these payments are like double from what they were compared to like when you got it, the 3%, sub 3% interest rates, so it just doesn't make sense. So why would you do that? And especially as an investor, and like you have, like you said, you have like, basically a responsibility towards your investors. So like you don't want to just to invest, so very cool to hear that you guys are on top of it.
Yeah, yeah. And the other thing is, um, how do I put this? We're a relatively small company, so it's not like we've got 10 employees that we're paying salaries to, and so we got to make deals. So we run kind of a low overhead operation, and so we're perfectly able to sit tight and do nothing. And of course, we're busy managing our current assets. and trying to improve the operations of them, get the rents up, fix them up if needed. So there's always plenty of stuff to do. But I think as a buyer, you always have to be out there looking, because you never know when an opportunity will come. And if you know your market, and I'm kind of a big old school guy, that your competitive advantage is knowing your local market. And so I believe you're in Carmichael, California, and
correct.
There are good buys that are going to be out there in Carmichael, California, but in order for a buyer or an investor to determine that, they really have to know the market, and they have to have confidence in their market knowledge, because as you know, if a good deal comes on the market, it's gone in the next day or so. So you have to have the confidence, okay, I know this market. Doesn't matter what market it is. I know this market. I know what property's worth. So when I see a good opportunity, I'm going to be able to move quickly to secure it. And you're only going to have that confidence if you actually know the market. So like, for example, with Brian and I, we know the Greenville market. We probably own 400 units here. And so when we go look at a new building, we know what those units will rent for. It doesn't take us 3 days of research. On the other hand, if you were to take me up to Charlotte, North Carolina, I don't know that market like the back of my hand, so I'm not really in a position to move quickly and confidently. So I would encourage all of your clients, your investors, and even home buyers, learn your market so that when the right property comes up, you have the confidence to go after it and you're making a smart decision to buy it.
Absolutely. And if you don't mind me adding, like, especially for the buyers, like, you have to be prepared to strike when that comes, because, some buyers are sitting back waiting for, to even get pre-approved, or thinking that, like, they don't want, their interest or their credit to get hit or whatever it may be. But if you're not, ready to make an offer, that dream house that you've been thinking about or whatever property it may be, is going to be gone, because it's not going to be, everybody's going to want it. It's going to be gone, you said, overnight.
Well, 100%. So if you're a residential buyer, have your pre-approval in place, have your proof of funds in place, and maybe have a personal letter ready that you can tell the seller. And at the end of the day, generally the highest bidder gets it, but you never know. Maybe there's something in your personal story that will appeal to the seller, and have all that ready and in place. So when your agent like Kevin sits down in front of a seller, he goes, here's the offer. And oh, by the way, here's the pre-approval. Their cash is in the bank. They're ready to go. Let's strike a deal. Your house is sold. Where if you don't have that, you're at a competitive disadvantage. And so get your ducks in a row. And what I found in my residential brokerage career is often a buyer maybe has to lose one or two houses. Unfortunately, and because like my buyers would go, is this a good offer? And I would go, yes, Rob, this is a good offer. But there's a difference between a good offer and a winning offer, right? And so in a competitive market, which certainly California is, you have to be prepared to step up and kind of win that. And I can also say in my long career, 99% of my buyers are happy and thankful they bought the house they did. Very few ever regret the purchase because the economics and the market, if you look at historical price trends, they're up. Every now and then you get a little bit down, but the overall trend is up. And can anybody make any rational arguments where the price of housing or the rental price is going to go down? I don't see that. So if you purchase what you can afford and you set it up properly, you're setting yourself up for long-term success.
Agreed.
Yeah.
I like that.
Yeah.
So given your experience, how do you approach market analysis for new investment opportunities? What key indicators do you look for?
Well, yeah. So great question. So, you definitely look at population growth. So you want to buy in areas where the population is growing. You want to have job growth. You want to buy in an area where businesses are coming in and creating more jobs. And typically those two go together. People move where the jobs are, right? So population growth, job growth. The other thing I would look at is, I think in general, you want to invest in an area where there's a diversified economy, meaning maybe you got a little tech. Maybe you got a little logistics, transportation. Maybe you have a little agriculture. Maybe you have a little manufacturing. I would stay away from towns where there's only one major employer because, economies change, markets change, industries grow and shrink. So you don't want to be invested in a kind of a one-trick pony town. Like, for example, Houston's very tied to oil and gas, though it's now changed. But so Houston booms when oil and gas is doing good, but it struggles when it's not. So I think a diversified economy with 2 or 3 major employment could be medicine, manufacturing, could be hospitality and leisure. So you want a diversified economy. And then I think the other thing you want is where in general household incomes are going up. You want to invest in an area where people are prospering, the vibes are good, there's kind of a growth. And then I would come back to the local knowledge. So, for example, in Carmichael, Sacramento, wherever, Marysville, where I was born in Marysville, Yuba City, so I know the Central Valley.
Yeah.
Within your community, there are areas that are starting to improve. And typically what you'll see is maybe a lot of home flippers going in and investing money, improving the property, and then you have an owner-occupant moving in. So property values are growing, people are investing. Or it could be a little neighborhood where some abandoned storefront is now a cool coffee shop, right? So and we all know, we all live at Greenville's no different. One side of the street could be great. The other side of the street could be a little problematic. So use your local market knowledge to identify the areas that are improving. And what I always say is try to invest in neighborhoods or areas before they become front page news. So if you're a local and you're paying attention, you might have a year or two jump before everybody else knows, neighborhood X is really hot and values are going up. So I would encourage your listeners to look for areas where you see investors or capital coming in, there's improvement, there's renovation, and there's some kind of commercial or retail component. Because I think one of the things I've really noticed over the years in terms of changing, I think my generation, almost 70, the dream was to live in suburbia at the end of the cul-de-sac on this nice lot. Okay, that was the dream, blah, blah, blah. Where I think the dream now is more, no, let's live in a place where we can walk 3-4 blocks and get coffee or have dinner, and a little more sense of community. And all over the country, we're seeing these little downtowns kind of being revitalized. So I have kind of seen the shift where the importance of walkability or bikeability is important. So I think if you can invest in areas that kind of offer that, because I think that's what people want, that they're missing with suburban life, is that sense of community. So a little bit closer in, a little bit walkable. That's kind of what I look for.
I like that. That's a very good point. I think you're spot on with that, at least from what I see, like in, just from the Sacramento area, because people like that community. And they're not, they're kind of going away from like people want a lot of property, but they're kind of going away from that as far as, wanting to be, like you said, to be closer, to be able to like bike and walk and stuff like that.
I mean, people want to get out of their cars. When you walk, you can actually say hi to somebody. And it's a little bit more relaxed lifestyle. And we certainly know everybody works hard for their money. Their jobs are demanding, they're stressful. And if you could take a little bit of that off and have a little bit more relaxed life, it works well. So that's kind of the trend I've seen. And it's kind of what I follow. So I kind of like those infill locations that maybe were a little rough, but they're starting to turn. And granted, people could drive 40 miles out or 40 minutes out and maybe get a brand new house, but then maybe they got to drive 20 minutes to go do anything. And so each family, each buyer has to weigh it, but that's kind of what I look for.
Good point. Yeah. So for those considering passive real estate investing, what are some of the primary benefits and potential pitfalls they should be aware of?
Great question. And we've kind of covered some of them. So the benefits of passive investing is you don't have to deal with any of the headaches of being a landlord or a property manager. You have professionals operating the asset for you. You simply receive quarterly distributions on the share of the profit. So those are the benefits. The risks are, and it's difficult sometimes for a passive investor to figure it all out. But in addition to the deal, the property, the market, I would also pay attention to the lead sponsor or the operator. That's the person who's actually responsible for running the deal. And there are a lot of good operators, and we now know there's
a lot of bad ones.
The bad ones, yes. And so what I would look for is, so my primary focus is Greenville, South Carolina, and I know how to work the real estate in Greenville, South Carolina. But if I was to call you up next week and go, hey, Kevin, I got this building in Phoenix, Arizona I'm buying, if I was you, I'd say, well, do you own anything else in Phoenix? Who's your property manager? What's your experience with them? Who's your renovation contractor? So I would only invest with operators that have a track record of owning properties in that market. So Dallas, Fort Worth is great. Austin's great. Charlotte's great. Raleigh, Durham's great. The Midwest is hot right now. Columbus, Ohio, Kansas City, Kansas. But I would want to work with an operator that actually has a significant footprint in that market. So that would be one thing I would look at. If they're all of a sudden doing a first deal on a market they'd never been, I would probably pass and let's see what you do. The other thing I would say is apartments are kind of graded A, B, C, and D. And so the A apartments are your brand new luxury downtown apartments, very expensive, brand new. And then, and then your class B are maybe more your garden style apartments. Maybe they're 20 years old and they're in decent areas. And then your class C is maybe product that was built 1970s, 1980s. Maybe we call it workforce housing. Maybe we call it affordable housing. And then, of course, D is like distress, really rough areas, crumbling building. Okay. So if an operator is great at the Class C value add, and that's what they do, if they all of a sudden brought you a Class A deal, I would wonder, because the skill that you need to do a Class C deal and how you operate it is much different than what you would do for a luxury apartment. So geography, but also asset type. So if a particular operator only does new buildings in Austin, Texas, and he or she brings you a new building in Austin, then as an investor, I would feel, hey, I think this team knows how to run these type deals. But if they brought me a value add Class C deal in Little Rock, Arkansas, I would probably go, well, wait a second, that's not really in your wheelhouse. So I'd kind of focus on that. And that would be kind of my guidance on it. So the other thing I would say is, if you have a sum of money to invest, you don't need to go all in on one deal, right? The deal of the century is going to show up next month too, I promise you. So what I would do is more spread out my capital, invest smaller amounts in 2 or 3 deals, little bit of a diversification, and then you could see who actually produces what they say they do. And I think there's a little safety. So kind of put your toe in the water, test it. And passive investing isn't for everyone, because basically the general partners in charge, they make all the decisions. So it's kind of a long-term investment and it's not liquid. So those are just some factors I might look at.
Got it. Man, see, only you would know all of that. Like, it takes a lot of experience to be able to even look for that type of stuff. So,
and I can tell you, I'm a limited partner investor myself. A couple of deals, half of them are doing great, quarter of them are doing mediocre, and another quarter are struggling. So
I see.
You know what I mean? So I'm a limited partner investor in maybe about 10 deals. So I'm speaking from experience, and I'm still learning as I go. So if you spread it around, then the thing I say about investing is, or life in general is, people are going to make mistakes. You learn from your mistakes. I mean,
Absolutely.
to think you're perfect and you're not going to make a mistake is absurd.
Yeah.
So I think the trick is make small mistakes, right?
There you go.
You know, so you get hit upside the head and you learn and you go on, but you live to fight another day, where you don't want to make a big mistake where it's a mortal wound or you totally get knocked out of the game.
Sure.
So go slow. And I think the other thing I would say is real estate is not a get rich quick deal. It's a long-term deal. And for me, I would say you're talking 10, 15 years. And if people get started now investing in real estate and even buy one house every 3 or 4 years, trust me.
That's still doing great.
They're still doing great. Trust me. 15 years down the road, they're going to be going, thank God I bought those houses, because the value of those houses will probably exceed their 401ks, but it's just not going to happen overnight.
I like that.
Yeah.
Yeah. Very nice. So what about, 1031 exchange? You've assisted many investors with 1031 exchanges. Can you explain the process and its advantages for real estate investors?
Yes. So what a 1031 exchange is unlike your primary residence, where if I own a home I live in and I sell it, the way the tax code's set up, if I'm single, $250,000 of the gains tax free. If I'm married, $500,000. So that's primary residence, something I live in. Mm-hmm. With rental property, it's different. If you sell it and you have a profit, you're going to pay capital gains tax on that profit. So what a 1031 exchange does is it allows you to defer the taxes. So for example, if you were to sell a rental property and you made $100,000 profit, or you got $100,000 cash out of it, if you didn't do an exchange, let's say you may have to pay 20% of that as a capital gains tax. So yeah, get a check from the title company for $100,000, but you got to pay the IRS $20,000 for that profit. So really you only have $80,000 to invest in your next deal. By doing a 1031, you don't have to pay any tax on that profit. So now you have the whole $100,000 that you can invest in the next deal. And so the 1031 is a good way to not eliminate, rather defer Uncle Sam's tax bite, which allows you to keep a larger amount of capital to invest. And the trick is basically, if you sell a property for $200,000 to do a tax-deferred exchange, you need to buy something more expensive. So it's generally used. So somebody maybe got a single-family house, they bought for $100,000, they sell it for $200,000, and now they're going to roll that money into a fourplex that costs them $400,000. With the 1031, Uncle Sam doesn't get its tax bite. And one other key is you can never touch the cash out of the sale. So as soon as you touch the cash out of the sale, it's taxable. So what people do is they get what's called a 1031 intermediary. And so the sale proceeds from your little rental house goes to the exchange company. They hold it for you. And then when you find the property to buy, they send the cash to the title company or the closing attorney. So there's rules, 45 days, 180 days. I don't know that we need to get in it now. But if you own rental property and you're looking to buy bigger, set it up as an exchange. Find a qualified 1031 intermediary, and there's plenty of them, and they can guide you through the process so you do it properly. It may cost you $1,000 to get the thing sold and the new buy, but think about it. If it costs you $1,000 to save, not paying Uncle Sam 25 grand, not to mention the state of California, it's money well worth it. So I've done a lot of 1031 exchanges. It's a great way to kind of multiply your rental portfolio. And again, at the end of the day, you're going to have to come to reckoning with Uncle Sam. But the longer you can delay that, the better, because that way you keep your capital working for you.
Cool.
Yeah.
Do you have you ever done a reverse 1031 exchange?
That's a great question. I actually talked to a client the other day about it. No. So some things sound great in theory, but they're harder to implement in practice. So
this is one of those?
This is one of them. So first of all, most people need their equity out of the property they own to go buy another one, right? So if you do a reverse exchange, you don't get that equity out of your original property, your current property. So you have to have the wherewithal to buy the new one without selling the old one. So that's problem number one. And some people can do it. That's fine. The other problem is, what happens is the exchange company actually takes title to the new property because you have to kind of buy it in their name so you can ultimately do the exchange. And of course, they're concerned about the liability of owning a property. When you do a normal exchange, they never own the property. They just hold the cash and they transfer it. With the reverse exchange, they actually have title to the property. So until you sell your original property to end up buying it, and so they often ask for a phase one environmental that costs $2,000-3,000, and there's other stipulations. So I would say for your normal mom and pop retail investor, owns a couple houses, owns a couple properties, it's probably not the most effective way to do it. Now, if you're dealing in really expensive properties and you have a lot of capital, it then can maybe make sense. So, for example, a typical exchange, maybe the fees are $1,000. On a reverse exchange, maybe the fees come to be $10,000. And so at a certain point, not to mention the problem of having to come up with the cash to buy it without selling it.
In the first place.
So you just have to kind of weigh it. And unless the numbers are bigger, it's probably not worth the hassle.
Makes sense. Yeah. Got it.
Yeah.
Well, thanks for sharing that. I just have heard of them. I didn't know how they even were able to pull it off. So that's very cool.
Yeah. And I work with First American Exchange, but there's plenty out there. But just so your listeners, if they know a name, and if you just reach out to the people, this is what they do every day. So they know the rules. They can just set you straight. So it's nothing abracadabra. It's approved by law. You just need to know what you're doing. Let them guide you, and everything will work out fine.
Makes perfect sense. Thank you.
Sure.
So with over 44 years in the real estate industry, what are some of the most important lessons you learned that you believe are timeless principles in real estate investing? And maybe a story or to go along with it would be cool.
Yeah.
You have any?
Well, yeah, I do. So I think number one, if it sounds too good to be true, it probably is. Okay. So
Like,
you're right. You know, be reasonable.
sure.
So, but what I would say is generally the only way people get hurt by real estate investing is by buying something they can't really afford. And usually what that also entails is over leveraging the property and not having cash reserves for when you need a new roof or the furnace blows up or whatever. Murphy's Law strikes. You'll lose
It's going to happen.
It's going to happen. A
Absolutely.
little rain must fall. So,
Right.
So, as long as you go in and properly leverage the property, and I'm a big believer in fixed rate debt because you know what that's going to be forever. And with inflation and everything else going crazy, it's great to know half your expense is set. So go into it, proper leverage, not over leverage the property. And then when you buy a property, try not to use every last penny you have to buy it. Have some cash in the bank in case problems develop, because the way people get hurt is if they get into a property that they can't afford or problems develop and they can't really afford to continue to own it, and then they have to sell in a down market, that's how you get hurt. So for me, I'm buying apartments now, and maybe the value's going to drop a little bit in the next year. I don't think we've quite hit bottom on the multifamily market, so values may drop a little bit. But I don't care, because I'm looking at what the finish line 7 to 10 years from now. Yes, so that's another thing, long-term perspective. So
I like that.
Even if the value drops a little bit, who cares if you're not selling, because the value's irrelevant. You just keep owning the property, and over a 5 to 10 year period, it's going to go up over a 10 to 15 years. So that's what I would do. And I can tell you, people may remember, in 2004, 2005, 2006, the real estate market was on fire. Prices were going up. It was crazy. As a realtor, I was making lots of money selling stuff in the San Francisco Peninsula. And I bought a brand new condo on the Big Island of Hawaii. I did, yes.
Nice.
So, well, cool. Nice, but it turned out to not be so good. So this is the story. Okay. It's okay. It's all right. Yeah. I didn't listen to my own lessons. Always easy to give good advice. So, as I say, we all make mistakes. You learn from the mistakes. So what it was it was a brand new condo in a development that was being built. And if people reflect back there, and it could have been in Stockton, it could have been in the Bay Area, what was happening is new stuff was being built, and every phase was more expensive than the next, right? The builder built 20, sold them for 300. Phase 2 was 350. Phase 3 was 400. So I contracted to buy this new condo on the Big Island in summer of '06.
Okay.
And I kind of penciled it all out. I was going to use it as a vacation rental, and the development had on-site management, and I kind of
Okay.
estimated how many days I'd have it rented, what my rental rate would be, and blah, blah, blah. So,
Okay.
and all those numbers were accurate. And
Okay.
it was going to cost me money, but because it wasn't going to be totally self-supporting, the rent would cover a lot of it, but I still would have to feed it.
I see.
And I didn't close to December of 2007. So I
Oh,
contracted summer of 2006, closed December 2007. And everything was great. And then, of course, we all know what happened. October 2008, the Great Recession, the subprime crisis. And for me, my income, I wasn't working for Apple Computer. I was making a lot of money, but I didn't have a salary from Apple Computer. So my income was tied to my real estate brokerage. And of course, that dropped significantly and the value dropped. And so I ended up having to sell it at a short sale, probably lost about $100,000. But it was okay. Lesson learned. I went on. And I think the lesson was, if 04, 05, 06 had continued, there would have been no problem. I could afford the condo. Now, nobody could predict the Great Recession and the subprime crisis and everything going to heck. But it's a good lesson when you go into real estate. Don't base it on the best case scenario. Understand things could change. So I got myself a little overextended, and it cost me, learned a lesson, and moved on. It took me a while to rebuild the credit, but it's all right. It's all good. I loved it.
You weren't the only one.
Yeah, not the only one. No, exactly right.
Yeah.
And so I can tell you, by going through that, I'm not going to do that again. And that's an example of learning a lesson that didn't wipe me out. I still had other rental property. I own my home. I have a good career. The career rebounded. I put everything back together, but I just got myself in a situation where several events all happened at one time that just proved to be difficult. So you learn a lesson. And so go slow, don't swing for the fences, line drive base hits, and just grow your wealth slowly. And that's probably the better way to go.
I love it.
Yeah.
Would you say that experience probably made you stronger in the end?
Yes, because you kind of learn, and it's, somebody could, your mom and dad when you were little could tell you, don't touch the stove when it's on. And you might go, what do they know?
Yeah.
When you do it yourself and you actually get burned, trust me, that will make a little bit more impression on you. So
you learn quickly.
You learn quickly. So, and it's okay, because you frame them as learning experiences and you get better. And I can say, I'm still learning to be a better investor. I don't know it all. I have great partners that have skill sets that I don't have. So it's okay to make mistakes, just learn from them and keep moving on.
Very cool. Well, Arn, we're about out of time. Did we miss anything? Is there anything else you wanted to add, or is that?
No, I just give a general pitch for real estate.
Absolutely.
media likes to be negative. And so doom and gloom sells newspapers, it sells advertising dollars. I have money in the stock market and I have a professional handle that for me. But most of the basis of my net worth and my financial security has been through real estate investing. And even with some mistakes, as we've just covered, long term, it still works. So I would encourage people to try to invest in real estate, do it prudently, educate yourself, go slow. I do believe in it, and I think it's a way for average people to kind of really improve their financial situation. So I would encourage people just to take a look at it and get started.
It's a great way to generate or generational wealth, to form generational wealth. Don't you agree?
Yes, and just to also, the other thing I would say is people are living longer, and I think people maybe rightfully have some concerns about Social Security. And so you need to create income streams even once you stop working. And real estate's a good way to do it. You can't really generate much income from stocks, but real estate can generate income. So encourage people to kind of think about that. When they're 50, 60, they're going to want to have income streams that support them in addition to their job or Social Security, and then eventually they can transition out. Yep.
Very nice.
Yeah.
Well, Arn, thank you so much for coming on to the podcast, and you provided so much value to everyone that hopefully I can't wait to put it out and get a lot of good feedback from it. I'd love to be able to, push it out at the same time and give you, that way you can kind of share it with the people that you know too, if that's all right.
Yes, and I'll be glad to share your content with my friends. And nice meeting you, and I hope things go well for you.
Thank you, Arne. I really appreciate it.
Yeah.
Have a good rest of your day.
Thank you.